Testing 1 2 3. Testing 1 2 3. How's sound, guys? All good? Okay, good stuff. Let's go then. So, hello, and a massive hello to everybody. No trade calls, no recommendations. Everybody responsible for their own stuff. We're here for educational purposes only. As usual, try and do this once a month. Just have a little bit of a chat. We'll stay on as long as people have questions. Happy to go through any chart, discuss anything anybody wants to discuss. No real agenda, nothing specific planned. So, hey, Stefan, how's it going? So let's go. I'm just going to talk a little bit through where I think we are and what's going on while people join. And if anybody wants to ask any question, shoot, more than welcome. And again, I'll keep on going as long as there's questions. Basically, we've been discussing, maybe it's better if I go on the ES and look at it this way. We've been discussing about the fact that we'd expect the ES to stay inside a broader range or a very, very tradable range this year unless something very specific happened. And basically our upside is 4,200, 4,100, and the downside is 3,800, 3,700. And we'd be faders of that range in terms of swing trades for, as I've been saying on Twitter too, market to come back into a little bit more neutral territory at the very least, which is around the 39.50, but at least to keep on ping-ponging around this range unless we get something more, out of the data, out of the Fed, whatever. We need to break out of this range, and unless we break out of this range, it's still a lot of chop. So in the same way where we were talking about longs towards the back end of last year, here we've been talking about looking for shorts and these failures here. So right now, the close below the 4,100 has confirmed, and our base case assumption is, again, at the very least, we'll be coming back towards this 39.50. Now, as always, it's all going to be data dependent. The Fed has told us higher for longer, asset prices lower, rates higher. And as long as data supports that, that's what you should be playing for, right? Of course, some people like to pull out their crystal ball and daydream about what could happen, what couldn't happen. But if you've been following price, you've been following the data, this is fairly clear. Now, here, this dynamic, and we're in a market which is still fairly technical, fairly easy, because this is respecting everything quite well. What we've been talking about is this move back towards the 200 DMA. And for those of you who's been following on Twitter, you'll remember I kept on talking about if you're not paying attention to the dollar, you're not really paying attention. So the moves we're in and we're playing for now is, ES back into this mid-range into the 200 DMA. If you're looking here also, this ugly breakout of Fangman, all the way back into the 200 DMA. If you're looking at something like gold, puke back into the 200 DMA, the 1800. Cable back into the 200 DMA. Aussie is already back into the 200 DMA. Kiwi is already back into the 200 DMA. So fairly classical action across the board. Euro, we were very bullish euro for a move back into 110. Look at how pure this is. Back into 110, negative reversal at the 110, and now moving back in towards mid-range, which is our 105 level. So again, the market's been fairly technical, even on this move up. Look at this reversal here. Very, very nice action. So I think we can't complain here. So we'll have to see what happens here with the next data readings. Today we got the FOMC minutes. We should probably see more talk about the 50 basis points. Again, that's probably priced in. We'll have to wait and see. I prefer to look at the levels. We'll look at the levels in a second. But more importantly, even than the prelim GDP is core PCE on Friday is going to be another key level to watch. And then we've got a lot of other interesting data points like, ISM and the before the next FOMC meeting. But again, you should fully expect that as long as the data keeps on coming in hot or stronger than expected, that, the market is going to have to move and price in the possibility of 50 at the next meeting. And 1 week ago, basically the market was pricing in virtually 0% chance of the Fed doing 50 basis points at the next meeting. Now we've moved to slightly above 20. And again, if the data continues to support, that will probably have to move higher. And that will probably mean yet again, asset prices lower, rates higher. We'll be talking about this in all the recent live updates too, so it shouldn't be any big surprise. Can you take a look at USD CAD? Sure. USD CAD. Here, this is one of the currency pairs which I'm not too interested personally in trading. It's just hard, It's also going to have to deal with shenanigans that we're going to see around in crude, right? And it's almost like in crude, every time we've got a situation where we're kind of getting towards the 70 mark or low end of the 70 mark, Biden and co say, we're going to be on the bid below 70. And every time we're kind of like above 80, they kind of panic and they say, okay, we're going to release more from the reserves. And so crude gets smacked. So it kind of looks like there's this huge ping pong around the 70, 80 mark. And CAD just gets caught in the crossfires, right? Really gets caught in the crossfires here. So I don't think that, Stefan, if you're looking for a nice swing or a big bang for your buck kind of trade, I don't think personally CAD is the one I would be focusing on too much. I think it's interesting if you're more of a tactical player, right? Having said that, where are we and what's going on? Well, it's still chopping around, really not too sure what to do. You got a lot of selling every time we get towards this 137, but it seems like you've got a decent floor here at the 132. So globally speaking, I wouldn't be surprised if we continue to chop around in this range until something specific happens. If you want to have lines drawn on the chart, you could probably have something like this drawn up. But, again, I'm not, do you see what I mean, Stefan? It's just very messy. I think there's far clearer trades out there, far more interesting dynamics than looking for CAD to break out. But because here, even if we start ripping, you've got a lot of resistance to the upside, so really trying to trade for a breakup, man, that's a hard one, right? So I'm just not, I think it's just very, very messy chart. The Dow, what's going on the Dow? Well, again, the easiest way is, you're seeing the Dow's holding a little bit more of a bid as people are unwinding tech, but, essentially it's pretty much going to be in line. All the indices are pretty much trading the same. So if we want to flip back on the Dow, basically what I would say is there are a couple of key levels you want to look at on the Dow. And basically one of the big pivotal zones, right? Similar to some of the other ones we've looked at, some of the other indices, basically is the 34,000 mark, okay? It's been a very, very key level. And here we're seeing, Randy, the same, hey, by the way, same kind of dynamic that we saw on the ES is that failure to hold above the 41 gets sold and moving back towards mid-range, the 200 DMA. And here, also very classic, you see what's happening. The market's trying to rip higher. Once it breaks, what's the path of least resistance? Very likely that we unwind at least to the base. And surprise, surprise, you've got the 200 DMA coming in here, okay? So as I said at the beginning of the of our chat today, is that it looks like everything needs to unwind into a little bit of a more neutral territory, which it would be that 200 DMA. Everything kind of got ahead of itself with, dreaming about a pivot, dreaming about rate cuts, right? And now that reality is going to set in. Even if we don't go higher for longer, chances are we stay here, mess around for a little bit. And that just means that everything has to come back to earth a little bit. And you could look at that as basically everything coming back into the into those 200 DMAs. So here, what you would expect on YM is similar to what you would expect on all of the other charts, is that as long as it can't regain the pivotal level, the path of least resistance, for it to come back down into a little bit of a more neutral stance, which is around this 200 DMA, then what you have to see here, then it's going to be 100% data dependent, right? If the data keeps on coming in hot and the market has to come in and price, go from 20 to 50 to 75 to whatever percent chance of a 50 basis point hike at the next meeting, then likely means we need to probe a lot lower, right? If the market is still in limbo, then it might feel comfortable around this 200 DMA. If you look at the way we rallied here, basically off these highs, what's happened is, this is probably a 38 retracement or something, and these failures are very ugly. So usually this kind of pattern also means that you don't necessarily want to be a buyer of the 50 back. Usually the 61.8 gets tagged. So it's not particularly, the picture is not particularly pretty technically, but it's all going to be data dependent, but everything points to more neutral, that around those 200s, okay? David, what about the VIX? I don't know. What about the VIX, right? The only true, mathematically pure, mean reverting asset. I don't know. I don't think there's anything specific to be. I mean, I don't know what to say on the VIX. If you have a specific question, more than happy to look at it. But pro tip, you never want to do technical analysis on the VIX. And, we're hovering here. I mean, would it be surprising to see us, see this kind of bounce a little bit, maybe come back down into the 20? Sure. Makes sense. Would it be surprising to see the VIX print in the 30s in the coming months, especially if data continues to trade hot? Absolutely not. But, I prefer to look at the levels on each specific chart than try to, really look at the VIX. What about Nvidia? Oh, don't we have earnings today, right? Is it after the bell today, right? So what's going on Nvidia? So basically, Nvidia, I think, Nvidia is going to trade with tech, right? It's pretty much going to trade with tech. The only thing you've got to see, it's almost like, gold and silver, they're kind of tend to trade together, but, silver is kind of like gold on crack. Here you've got a kind of situation where, especially to the upside, Nvidia is going to trade like tech on crack, especially if you see everybody bounce on, whether we get something like crypto, whether we get something about AI, etc. Clearly Nvidia is the best bet. So it's kind of like a tech play on steroids. But it's not going to trade very dissimilar to anything else. Look at Nvidia on the weekly, right? You see how we've come back down. We've got this ugly failure on the weekly, where if you go back and you look at a Fangman chart, you see it's exactly the same chart. The only thing is you would expect, Nvidia probably to trade a little bit stronger because of all the other, all the industries that are ripping are very much linked to a play on Nvidia. But so, it's all the same trade as always, but Nvidia you'll probably get a better bang to your buck, especially to the upside. If you're looking at PE ratios and stuff like that, that's so 80s, right? So people looking at numbers, I mean, who cares? People are just going to YOLO stuff here and there. I think the interesting thing on Nvidia is that if we see everything unwind, you still have quite a long way to go to the downside. But clearly, especially if you're looking for a longer term position, any move back into this whole, 185, 160 range is clearly a fairly interesting zone. This was a fairly strong move. Basically lows into highs. It's quite pure, right? Look at this. So we come in lows into highs, we retrace, we hold the 61.8, and basically this is fairly pure symmetrical move all the way back, and we fail right at that 150 extension. So you see it's fairly technical here. So right now you move the fib to the new high, right? Even though you've got a double failure there, this would be a nice place to start to nibble, especially for longer term positions, right? But no, I'm not going to trade. I don't trade single stocks, but it'll probably trade in line with the market. Thanks, Randy. How would I add to your tech short? Well, you wouldn't do anything for now, right? We can look at that later, right? But let's look at gold. Actually, let's look at tech. I mean, it's the same thing. Like, even if you're looking at, it's a bit of a messy chart, right? But you see here, you've got this NASDAQ. Remember the range, Vic, we were talking about was basically the 13,000, 12,000, 11,000. We're looking for that failure at the 13,000s to give us back into 12,000, which is in line with the 200 DMA, right? So this is really, we're there. So this should be a bounce zone. You know, if the bulls can't hold this today, it's likely going to get fairly ugly. You should see a bounce zone. So here, ideally, you want to be short. It's really suboptimal to have to chase a break below the 12,000, because all of a sudden you're going to be coming into a lot of fib support zones here, the retracement from A to B. You're going to be coming into the 50, the 100, right? So here, if you remember, we're talking about this, all the YOLOs getting excited here to get long, and we're putting on those shorts to play for the 12,000. Now, if you read the press, Twitter, the forums, every YOLO is getting excited to get to short. So really, you should be covering. You should be covering your shorts, right? Because of course it could go down 10% in a swoosh, but percentage play here, you know, now that the longs are getting bearish, this is when you want to be covered and maybe play for a tactical long. So, of course, on an ugly break intraday, you can try and get short with a tight stop, looking for a complete flush. But ideally, what you would like to see here, if you want to see a very technical market, what you'd want to see here is, now, more responsible players that were short start to cover a little bit today, maybe into the FOMC minutes, ahead of the FOMC minutes. Maybe you get a little bit of a silly squeeze and we see a pop back into that 10-day moving average. And then that's probably an interesting place to try and lay them on for the next leg. On a full leg into the 100, a little bounce back into the 12,000, that's probably an interesting place. You see what I mean? I mean, it doesn't have to trade like that, but if you want to trade with the best asymmetry and a very systematic way, it's always better to play for how the market tends to trade 80% of the time, or how the market tends to trade the majority of the time, not to always play for outlier moves. So clearly, after the market has been down here 3 days, could we be down 15% today? Sure. Is that likely to happen? Is that statistically the most likely outcome? No. So, you know, you have to be comfortable. If you want to be solid, you have to be, you have to aim for the boring trades. You have to be comfortable that sometimes you're going to miss stuff that looks really good, but over the long term, you know that you're always taking the percentage play, right? And that's the most repeatable way to trade and to have consistent results, not getting lucky or pressing it every once in a while. Okay, so I still owe somebody chat on gold. So let's get back on gold. What's going on gold? So basically, gold, we talked about it briefly yet, but basically still, you'd expect this if we see this move continuing, you know, with yields higher, the dollar's firming up, a little bit of risk off coming in, you'd expect that gold to come back towards the Good to know, to go towards that 1800 level, right? Now, the same thing here, we were, where everybody was bearish gold, we're very bullish gold, especially playing for the seasonal December ramp into the new year. But then, we're lightening up here because look at it on the weekly. This is where you want to get bullish gold, right? Big range we've been trading for a couple of years. False break below. Failure to hold below, back above. That's your long. That's where you have asymmetry. So your risk for move to mid or opposite side of the range. Once you're getting up here, right, everything's starting to turn. You could see on the weekly, it's starting to struggle. This is a place where it's being offered hard before, and you get this weekly close right here. That's not the place to get bullish gold, right? So that's all people who are, new shorts and all the longs taking profit into late longs. So here, the chart really doesn't look that nice, right? It looks fairly fugly. I mean, look at every time we failed from this level. Look at how ugly the moves have been. So sure, there's going to be people calling for 5,000 gold, but since the beginning of time, there's somebody calling for 5,000 gold. Here, if you look at it, the only thing that seems clear is that this 18,000 is a very, very pivotal zone, right? And this is where the 200 DMA. So our base case is that this is where we're going to come to, and it'll have a decision to make here. In any case, even on a bounce here, it's still ugly because it's still making lower highs. It's not a pure chart. So here, if you're buying gold because fundamentally you're making a case for gold because your crystal ball told you, because your dentist told you, but you're not buying gold because the chart says buy me, buy me, buy me. It's a beautiful pattern, right? That's the that's the bottom line. So here, again, I think the weekly is a good chart. And what I suspect is if we get a situation where the data continue to stay a little bit strong, but market's going to settle on 5.5, then probably gold will try and find some kind of a base here around the 1800. If we have a situation where you're getting inflation is persistent and the market has to start to price in, 6.5 higher, then you should not be surprised to see gold flush back into, the 200-week back lower. Keep in mind, everybody, their pet goldfish and their hamsters been buying gold, especially into these highs. So there's a lot of late and weak longs that might need to unwind. But bottom line is, for the past 2-3 years, it's just been a range trade. And it continues to be a range trade. Actually, high, low, low, high, low, and this has failed. So technically, if I'm looking at the range, this points to a move back to the bottom end of the range. Okay, that's the way I would look at it. Again, I think the thing is that handcraft is that nobody has a crystal ball. And anybody's view is as good as anybody else's. So I think at least what we can do with the technicals is have a little bit of fun, and but at least look at what price is trying to tell us, right? And it's hard to argue with the fact that here price is not bullish, right? It's just not that bullish. Hey, what's Shambles? How's it going? So, any comments, any questions, anything anybody's looking at, anything anybody wants to discuss? Yeah, we looked at Dow. We looked at Dow earlier, and our base case is that, we should come back down into that 50 DMA kind of area like everything else. The Dow is a little bit different, though, in the sense that what I would say to keep in mind on a Dow, and something, a lot of times people look at different kind of rotations in the market, and they use them to kind of justify their bias, right? So if they're short and one day NASDAQ is down, but YM is up, they'll say, oh, look, it's bearish because NASDAQ is down, right? And then if the next day NASDAQ is up and YM is down, they'll say, look, it's bearish because YM is down. But keep in mind that in general, rotations like that in the market are actually bullish. They're not bearish, right? The only thing that's truly bearish is when everything gets smacked hard at the same time, right? Or the usual risk-off plays. So here you have to be careful, because what we've seen to a certain extent is a lot of times when you're seeing tech sold, the money's going straight into YM or Russell, right? So just keep an eye on that dynamic, that as long as you see these rotations still in play, fundamentally it means it's a money that doesn't want to be out of stocks, right? That's still looking to be invested in stocks, and it will hold some kind of a slight bid tone under the market. But in general, I would say, if we're going to sell off because data continues to be hot, and if we continue to sell off because the Fed speakers continue to talk about 50 basis points, yada, 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 in theory, nobody knows, but in theory, you'd expect tech to continue to get whacked more than value, right? So just be careful. JPY, sure. What's going on yen? So, USD JPY. What's happening? So again, our base case was that, this top was going to hold. This was going to be a structural swing high for a very long time on yen. And right now we're kind of hovering. We talked about the fact that we were, over the holidays, we'd be sellers into the 135. We got a nice little sell for new lows print. Now we've got a little bit of a wheeling and dealing. We'll have to see what Kuruda does, what Kuruda says. Keep in mind that on Friday, if I'm not mistaken, we've got basically, we're going to have some kind of a speech from Wada, which is supposed to take over from Kuroda. So we'll have to see what happens there. I doubt he's going to make a fool of Kuroda before he even takes office. So be a little bit careful here. Technically, what is the chart saying? Well, basically, it's like all the other charts, right? Where we're looking for this move to a little bit more neutral, which is the 200 DMA. If you look at the move off those highs, basically you've got the 50 back coming back into those highs. So really, this is a whole area which is really important for the bears to hold and for the bulls to break. So for me to get, I think it gets very, very ugly. If you start to print back above 141, 142, then something strange must have happened and you'd see a big squeeze. But ultimately, I would still expect the market to hold this whole area. And I expect to be the most public trade on the board is to look to be short USD JPY for some kind of change in policy before the end of the year, which could come at the end of the summer or even in closer to the end of the year. We've had Mr. Yen on deck calling for yen into the 120s. He rarely misses a call. So I think if you're chasing it to the long side, you have to be very, very careful. I think tactically short term, this is not a very interesting chart to trade. It's kind of like USD CAD. Not interesting to me at all. If you're trying to position for a swing, I would be more partial to looking for some kind of short exposure. But again, you have to really think how you want to structure that trade, how you want to lay out that trade, because it might be a trade that pays out of the back end of the year. So it's not such a clear call, but fairly similar to all the other charts, right? If you go back to the DXY, that's what started it all, right? Kept on saying, if you're not paying attention to DXY on Twitter, you're not paying attention. This is a false break. We've seen these across the board. high odds that we go back and tag the 103. Why was the 103 so important? Because this was the big range we were stuck in. And the break below, back above, kind of like what we discussed earlier on gold, is a massive false break and high odds that we shoot up back into mid, back to a more neutral territory, back into the 200 DMA, which gives us 106. And this is what's trying to play out. And as long as this plays out, again, you'd expect asset prices lower, yields higher, everything to gravitate back into those 200 DMAs, right? That's what you would be looking for. Any comments, any questions? Okay. Questions? Looks like we've answered, oops, not what I wanted to do. Looks like we've answered most of the questions. I think we've gone through pretty much everything. Again, if there's anything anybody else wants to go through, more than happy to go through it or review it, or we're going to call it a day. How long have we been going for? Probably... maybe 30 minutes, something like that. Okay, so looks like no more questions. Well, guys, thank you so much for stopping by. It was a pleasure. It was fun as always. We'll do it again in a month or so. If you have any questions, don't hesitate to hit me up on Twitter. Check out the blog, and talk to you guys soon. Okay, all the best. Take care. Thank you so much for stopping by.